Hey everyone, in this video, I'm going to be talking about the yield curve and how it can affect any mortgage decisions, specifically between adjustable rate mortgages and fixed rate mortgages. So the yield curve is basically just a line that plots yields or interest rates of bonds. We're going to be looking at bonds of the same credit quality. So just basically means the same type of bonds, the same riskiness, but the only thing that's going to differ is the time to maturities or the length of the bonds, the lengths of the maturities, I mean. So basically what I mean is if you were to compare a 30-year fixed mortgage to a 15-year fixed mortgage, same thing, same profile, just different time periods here. And the slope of the yield curve is something that we'll want to pay attention to because it will be able to give us an idea of future interest rate changes and economic activity. And there are three main different slopes or three main shapes here. Number one, normal, two, inverted, and three is flat. And flat is usually just a transition between normal and inverted. So we'll take a look at normal and inverted here. Normal yield curve. This basically happens when longer maturity bonds have higher yields than the shorter term bonds. So when we look at this graph over here, it's what a normal yield curve looks like. As you go to the right, longer in maturity on the right side, it's going to have a higher yield. So if you pinpoint it on the yield line, it'll be up higher than any of these shorter term bonds over here. So basically means that longer term bonds are riskier just because you're lending out money for a longer period of time. So the investors that doing that, they want to get a higher payout for holding their bond out for 30 years as opposed to maybe a 10 or 15 year. So those shorter bonds generally have lower rates. And this yield curve is usually indicative of economic expansion. It means we're kind of heading in the right direction in terms of that. And the only problem with that, though, is obviously as economic growth happens, so it's often accompanied by inflation. But inflation means that we will have higher interest rates. So as to the cyclicality of that, I don't know if that's a word. Point is the economic cycle. That's what I'm referring to. Inverted yield curve. This is the exact opposite. Again, we'll move to flat as we go to the inverted yield curve. Shorter term bonds have higher yields or rates than longer term bonds. So if you look at the graph here, just the opposite of normal. Over here on the shorter length maturity, we will have higher rates, and in longer length, you'll have lower rates. And it's indicative of the opposite, economic contraction or recession. So you can usually use that as a warning sign. And it typically results from increased demand for short-term credits. And the way that I want to think about this is that in times of economic contraction or recession, a lot of people may be struggling to make ends meet. So they'll turn to credit cards or other short-term credits, right, to make them or help them get by, make ends meet, pay bills, whatever it may be. And if that's their only option, then they're more willing to pay a higher rate on those cards or whatever the loans that they need. So that's one reason as to why this happens, right? And you may be asking yourself, well, why does the yield curve matter? What do you care? What can you take from this? So like I mentioned, generally speaking, it's important to track those macroeconomic trends, and the yield curve can be an indicator of what's going to happen in the future. But it can also affect your mortgage decision. If you are someone that's deciding between an adjustable rate mortgage or a fixed rate mortgage, you would want to look at the yield curve and see what's going on, because in the adjustable period of an ARM, this is if we're talking about a hybrid ARM that has a 3, 5, 10-year fixed period, then in the adjustable period, it will help giving you an idea of what the rate will do, where you'll be at. And like I mentioned before, ARMs are indexed on short-term benchmark interest rates, such as the secured overnight financing rate. So when I mentioned, I'm actually going to show you an example here. And I want to show you here. This is just the same loan, basically the same loan, $1 million purchase price, 20% down. These rates that I got here, I want to tell you how I got this. So for the ARM, we have 7.05%. Now, if you remember my previous video, an ARM rate is made up of an index plus a margin to get the whole rate. So the index that we're using here for the ARM is the SOFR, which is over here, 4.3% as of January 12th, 2023. And a lot of ARMs typically have a margin of 2.75%. So that's what I'm adding up to 4.3% to get you a rate of 7.05%. Now I want to check a benchmark for, I'm using the Mortgage News Daily here, and that's at 6.09%. So we can just basically take that at face value to compare apples to apples here. And this is similar to what we would kind of see in the given market right now, which makes your payment about $500 higher. And so that's something that you would want to consider if you are close to getting into the adjustable period of an ARM. I also do want to show you what the yield curve looks like to help give you an idea of where we're at right now. This darker blue line shows where we were a year ago, right? Here's the short-term bonds at lower rates, and longer-term bonds at higher rates. Normal yield curve, obviously looking a little flatter. It's kind of indicative that we're in that transition. And again, this is based on U.S. Treasury rates, so not directly correlated to mortgage rates, but there's that. And then this top gray, or not, I guess lighter blue line is where we are now. This is a legend right here. Short-term bonds, 2-year to 3-year, are at higher yields or higher rates compared to our longer-term bonds over here. 10-year and 30-year, the high threes. These are high threes and low fours. So you can see what that looks like there. Hopefully this helps. One more thing I do want to show you, just so you can kind of see what the difference is in loan amounts. I'm going to change the purchase price to 500,000, just to give you an idea. Again, it's important to understand how the different prices and loan amounts affect your payments. So just playing around with that, here's, boom, there you go. So same rates, just different payments. Now it's about a $253 difference, but still something you want to pay attention to. Hopefully this helps. If you have any questions about yield curves, ARMs, fixed rate mortgages, you want to see some differences yourself, then let me know. I'd be more than happy to help you price some things out. And as always, please like, comment, and subscribe. And I hope that everyone has a great day. Sweet. Thank you. Bye-bye.